Today is May 15th, 2026.
Not tomorrow, not coming soon. Today. As of right now, Jerome Powell is no longer the most powerful central banker on earth. Kevin Warsh officially takes over the Federal Reserve today, and in the last 72 hours, three things happened that Wall Street doesn't want to put in plain English for you. Inflation just printed at 3.8%, the hottest reading since May 2023. Silver is sitting at $83 an ounce, up more than 159% from this time last year. And the man now holding a $6.7 trillion balance sheet just got confirmed by the closest Senate vote in Fed history, 54 to 45.
That's not a routine leadership transition.
That's a fault line cracking open in real time. What happens at the first FOMC meeting in June, the first one Warsh chairs, will set the direction of your purchasing power, your savings rate, and the real value of every hard asset you hold for the next 4 years. If you've got physical silver, cash in a savings account, or paper precious metals exposure, stay with me. Because the picture I'm going to show you in the next 20 minutes is very different from what you'll hear on financial television today. Let's get into it.
Everything in this video is for informational and educational purposes only.
I'm not a licensed financial advisor. Nothing here is financial advice. Always do your own research and speak with a qualified professional before making any investment decisions. Let me give you the facts, then I'll show you why they matter in a way most people aren't connecting yet. Kevin Warsh was confirmed Wednesday, May 13th by the United States Senate. 54 votes yes, 45 votes no. One Democrat, Senator John Fetterman of Pennsylvania, crossed the aisle.
That 54-45 vote is the slimmest confirmation margin ever recorded for a Federal Reserve chair, ever.
In the modern era of the Fed, we have never seen a chair confirmed by a margin that narrow. To put that in perspective, when Janet Yellen was confirmed in 2014, the vote was 56-26. Ben Bernanke got 70-30. Alan Greenspan in 1987 was confirmed 91-2. Those aren't just numbers. They represent the degree of institutional confidence the Senate placed in each incoming chair. Warsh got just barely over the line. Why does that matter?
Because a Fed chair who steps in politically weakened is a Fed chair who faces an immediate credibility test in the bond market, the currency market, and the gold and silver market. The moment he opens his mouth at that June press conference, every trader on earth is going to be asking the same question. Is he independent, or is he Trump's guy? Here's the background. Trump spent months publicly demanding rates as low as 1%. The Justice Department, in a move that shocked central banking observers globally, launched a criminal investigation into Powell during the confirmation process, widely seen as a pressure campaign to clear the way for Warsh. That investigation was eventually dropped, but the message was sent. The DOJ doesn't open investigations into sitting Fed chairs. That doesn't happen. It happened this time. Senator Tom Tillis of North Carolina blocked the committee vote for weeks, demanding the investigation be dropped as a condition of his support. It was dropped. Tillis voted yes. That chain of events is exactly what 45 senators voted against. Not Warsh personally, but what his confirmation represents. A central bank whose independence is being stress-tested publicly and openly in real time. And here's the deeper issue. Warsh himself called for regime change at the Fed in a CNBC interview last year. He has been openly critical of the current monetary framework. He's told the Senate committee he wants messier rate-setting meetings, a good family fight, his words, where decisions are more contested internally. That is a fundamentally different Fed than the one Jerome Powell ran. And the market hasn't fully priced what messier means yet. Here is the central tension that nobody on mainstream financial media is explaining clearly, and it's the one you need to have burned into your memory. Warsh wants to cut rates. Trump wants to cut rates. The Morgan Stanley consensus expectation has been cuts in June and September. But here's the problem. Inflation is at 3.8% and accelerating. The April 2026 CPI print, released May 12th, just 72 hours ago, came in at 3.8% year over year. That's the highest reading since May 2023. Energy costs surged 17.9% annually, the steepest rise since September 2022. Gasoline jumped 28.4%. Food at home climbed at 0.7% in a single month. The driver is the war with Iran. The U.S. national average gasoline price has climbed nearly 50% since the conflict began. Energy doesn't stay in energy. It bleeds into everything. Shipping, manufacturing, food production, every supply chain on the planet. And here's where the contradiction gets sharp. The Fed funds rate today sits at 3.50 to 3.75%. With inflation at 3.8%, real interest rates are essentially zero or slightly negative right now. If Warsh cuts even modestly, say 50 basis points, you're looking at deeply negative real rates in the middle of a hot inflation environment triggered by a live military conflict in the world's most important oil-producing region. The bond market has already started pricing the contradiction.
As of this week, CME FedWatch shows traders assigning a 20% probability of a rate hike in October and 30% probability of a rate hike in December. Not a cut, a hike.
The market is beginning to think Warsh may not be able to cut at all and might be forced to do the opposite.
That creates a binary outcome in June that's unlike anything we've seen since 2022. If Warsh cuts despite 3.8% inflation, the dollar drops, real rates go deeply negative, gold and silver explode upward, and inflation potentially reaccelerates into year-end. If Warsh holds or signals a hike, the dollar strengthens, equity markets sell off, and we get a deflationary shock in asset prices before the next round of fiscal pressure forces a reversal.
Silver responds violently to both scenarios. It's not a question of direction.
It's a question of which explosive goes off first. And there's a third scenario that's the most dangerous of all. Warsh tries to thread the needle, acknowledges inflation, signals data dependency, refuses to commit, and the market gets no clarity. In the world of less forward guidance, he just promised the Senate that's not a communication strategy. And that's a volatility machine.
Let me pull back from the Fed for a moment and show you something structural in the silver market that exists completely independent of who chairs the Federal Reserve.
The COMEX is the primary U.S. futures exchange, where silver contracts are traded and, in theory, where physical metal can be delivered when those contracts come due. As of mid-May 2026, registered silver in COMEX vaults, the metal that is actually immediately available for delivery against futures contracts, sits at approximately 76 to 80 million ounces. Well, that sounds like a lot. Here's the other side of the equation.
Total open interest on COMEX silver, the paper claims stacked on top of that physical metal, stands at approximately 575 million ounces.
Do the math. The delivery coverage ratio is 13.4%. For every single ounce of real deliverable silver in those vaults, there are 7.5 paper claims sitting on top of it. Below 15% is where COMEX analysts define stress territory. That threshold hasn't just been breached, it's been sitting below 15% for 6 consecutive months without improvement. The drain is not slowing.
In early January 2026, a single week saw 33.45 million ounces pulled from registered inventory. Roughly 26% of the entire deliverable pool gone in 5 trading days.
It was never refilled. The system went into the April 1st notice day smaller than it was in January. This is the physical market telling you something the futures market is not yet saying. Why does this matter for silver holders right now?
Because when a delivery squeeze hits COMEX, when the number of contracts standing for delivery starts to approach available registered inventory, one of two things happens. Prices spike sharply to make enough contract holders settle for cash instead of metal, or the exchange restructures the rules to protect itself.
Neither outcome is good for paper silver holders. Both outcomes are very good for holders of physical metal because the floor under physical silver prices would reprice permanently. Now layer the structural supply picture on top of this.
The Silver Institute has projected a 46.3 million ounce shortfall in the global silver market for 2026.
That's the 6th consecutive annual deficit. The world has consumed more silver than it mines for 6 straight years. Solar panels, electric vehicles, 5G antennas, AI server infrastructure. Each of these technology categories is consuming silver at rates that didn't exist 5 years ago, and that demand does not respond to who chairs the Federal Reserve. It responds to the physical reality that modern technology requires silver. Silver hit a nominal all-time high of 121.64 per ounce in January 2026. As I'm recording this on May 15th, it's trading at approximately $83 per ounce. That's a 32% pullback from an all-time high. In the middle of an environment where the structural supply deficit is worsening, COMEX vaults are draining, and the incoming Fed chair just became the biggest wildcard in global monetary policy in a generation. That combination, deep physical tightness, structural deficit, and a macro policy inflection point, is where asymmetric setups live. Here's the historical lens that puts everything else in context. The United States is currently carrying approximately $39 trillion in gross national debt against an economy of roughly $28 to $29 trillion. Debt to GDP, however you measure it, is approaching the all-time record set after World War II. In 1946, public debt to GDP hit 106%. Right now, we're closing in on that number from below. What did the government do in 1946? They didn't pay it down. That's not how it works at those debt levels. They grew around it, and the mechanism they used was financial repression, keeping nominal interest rates artificially below the rate of inflation so that the real cost of borrowing is zero or negative and the debt gradually dissolves relative to the size of the economy. By 1974, debt to GDP had collapsed from 106% down to roughly 25%. The process took 28 years. Who paid for it? Not the banks, not the asset holders. The people who paid were ordinary savers. People who did everything right, who kept their money in a savings account or CD or a treasury bond, and who watched their purchasing power quietly bleed out year after year at a rate they couldn't see or measure. It didn't come with a withdrawal notice. It evaporated. The technical name for what happened to those savers is financial repression. And with inflation at 3.8%, the Fed funds rate at 3.5 to 3.75%, and a new chair who called for rates near 1% before the Iran war complicated his math, we are watching the 2026 version of that playbook being attempted in real time. The difference this time is the inflation variable. In the post-war period, the government had enormous control over where prices went. Today, with a shooting war in the Middle East driving energy 17.9% higher, and a structural deficit in a critical industrial metal now 6 years deep, the government's ability to repress rates without letting inflation run significantly hotter than intended is genuinely unclear. That's what makes Warsh's first FOMC meeting in June so consequential. He is walking into a position where financial repression theory says cut rates and let the debt dissolve, but the real economy says inflation is already above target and getting worse. He cannot do both. And the choice he makes, or the lack of clarity he provides, is going to move markets. Here's what history says about who wins in financial repression environments. Equity holders with pricing power do well. Companies that can pass cost increases through to consumers and protect margins. Productive real assets, real estate that generates income, commodities in structural deficit, tend to hold value. The consistent losers in every financial repression episode are fixed-rate paper holders, savings accounts, long-term CDs, bonds with locked-in rates that don't keep pace with real-world price increases. The categories from 1946 haven't changed. The names have. The mechanism is identical. Let me spend a few minutes on the specific statement Warsh made to the Senate committee that is getting the least attention and deserves the most. He told the committee he is not a fan of forward guidance, the practice of explicitly telegraphing future rate decisions in advance, through the dot plot, through press conference language designed to reduce market volatility by making Fed moves predictable. He wants messier meetings. He wants internal dissent. He actually used the phrase good family fight to describe his vision for FOMC dynamics. Jerome Powell ran a very different institution. Powell used forward guidance as the primary tool to manage market expectations. The dot plot, the press conference language, the careful calibration of every word in the FOMC statement, all of it was designed to give markets a runway. Volatility was dampened by predictability. Take that away, and you change the fundamental nature of how price discovery works across every asset class the Fed touches, which is all of them. In a world with Warsh-style reduced forward guidance, every single economic data release becomes a guessing game. CPI drops, Warsh might cut, or he might not. Employment numbers miss, nobody knows in advance how he weights that. Oil spikes because of another escalation in the Iran situation. The old Fed would have telegraphed its response. The new one won't. For silver specifically, this matters because silver already has higher beta to macro policy surprises than gold. Gold absorbs shocks steadily. Silver amplifies them, both up and down. In a world where the Fed surprises the market more often than it guides it, silver's volatility profile goes up structurally. That means bigger one-day moves in both directions. That means position sizing and liquidity matter more than they did 6 months ago. For paper silver, SLV, PSLV, leveraged instruments like AGQ, this environment demands serious attention to sizing. AGQ's 2x daily leverage means a 10% move in silver becomes a 20% move in your account in a single session. Around binary policy events, and Warsh's first press conference in June is the most binary policy event since the 2022 rate hike cycle began, that kind of exposure can be account ending if you're sized beyond what you can hold through a drawdown. Physical silver sits entirely outside this volatility dynamic. It doesn't get margin called. It doesn't have a daily reset. It doesn't track perfectly to the spot price on a 2 times leveraged basis. It is what it is. And in a world where the Fed is deliberately making itself less readable, that simplicity has a value that's harder to put a number on. I want to give you something specific and actionable before we close. Not predictions. None of us can predict this with certainty. But 3 signals that will tell you how this is resolving before the broader market figures it out. Signal 1, the dollar index in the week after Warsh's first public statement. If Warsh's first communication as chair leans dovish, emphasizing growth risk over inflation risk, signaling openness to cuts despite the 3.8% CPI reading, watch for the DXY to weaken. Every dollar-denominated hard asset gets a mechanical lift when the dollar loses ground. You don't have to forecast what Warsh will say. You just have to watch what the dollar does the hour after he says it, and position from there. Signal 2, COMEX registered silver inventory through May and June. Watch the daily vault reports. If registered inventory, already sitting at 76 to 80 million ounces against 575 million in paper claims, continues to drain while the paper price stays relatively calm, That divergence is the tell. Smart money accumulates physical inventory before price discovery catches up to physical reality, not after. The inventory number will move before the spot price does. Watch the inventory. Signal 3, the exact language. Warsh uses to frame the June FOMC decision. This is the one that will move markets most. Specifically, how does he characterize the balance between the growth risk and the inflation risk? If his statement leads with growth concerns, soft economy, tariff uncertainty, the need to support employment, that's a signal toward a faster cutting cycle, and gold and silver will respond immediately. If he leads with inflation, energy prices, the Iran war shock, the 3.8% CPI print and rising trend, that signals a slower or no-cut cycle, and you'll see a short-term pullback in metals before the market figures out that financial repression is still the long-run destination either way. You don't need to trade the announcement. You need to understand the signal and have your position sized so that whatever the outcome, you're not being forced into a panic decision at the worst possible moment. Here's what I want you to take away from the last 20 minutes. Warsh officially chairs the Federal Reserve as of today, the closest confirmation vote in the history of the institution. He inherits a $6.7 trillion balance sheet, a 3.8% inflation rate driven by a live military conflict, a national debt approaching World War II era levels relative to the economy, and a silver market where the physical delivery coverage ratio has sat in stressed territory for 6 months straight. The path he chooses at his first FOMC meeting in June, cut despite the inflation, hold or raise or say nothing clear, is going to be the biggest monetary policy signal since the Fed started its rate hike cycle in 2022. And unlike 2022, there's no playbook for navigating financial repression, geopolitical oil shocks, a compromised COMEX physical market, and a Fed chair who just told you not to expect advance notice about what he's going to do next. The people who came through the 1946 to 1974 financial repression period with their wealth intact weren't the smartest traders in the room. They weren't the fastest. They were the ones who understood the structural direction of travel, the debt, the playbook, the inevitable mechanism, and positioned themselves before the crowd connected the same dots. The dots are on the table right now. All you have to do is look. If this gave you clarity on what's actually happening today, a like or a subscribe genuinely helps this channel reach more people who need this information before the June meeting. Drop a comment below. I read every single one. Are you holding physical, paper, cash, or a mix? Let me know where you're at and what questions you still have. Stay sharp, stay positioned.